In this video, we're going to take a look at our retained earnings account. The retained earnings account, as you know, is an equity account or what we call stockholders' equity account. It has a normal credit balance, which means if you see a retained earnings account that has $10,000 positive balance, it would be on the credit side. It is a permanent account, which means the balances of this account carry forward from year to year. In fact, you know that the retained earnings account is a cumulative balance of all the profits, all the losses, and all the dividends paid out to stockholders since beginning of time. It's just a cumulative balance. Let's look at the anatomy of the retained earnings account. As we said, the retained earnings account has a normal credit balance, so you would see it on the credit side. That's the beginning balance. Increases to the retained earnings account occur on the credit side. What causes retained earnings to increase? It's net income. So whenever the company makes net income, it increases the retained earnings. When does it increase retained earnings? We actually transfer net income to retained earnings during the closing process. Net income is transferred to the retained earnings account in step 3 of the closing process when we close out the income summary account. Next, let's look at decreases to retained earnings. Dividends cause retained earnings to decrease. So net income causes to increase. Whenever the company pays out any dividends, it'll decrease retained earnings. Dividends, again, are only transferred to the retained earnings account in your step 4 of the closing process when we close out the dividends account. Sometimes, depending on the textbook you use in your class, they may not have a step 3 or a income summary account. They may just do revenues and they'll say revenues increase retained earnings and expenses decrease retained earnings. But this is a more cleaner way of doing it. So a lot of textbooks use the income summary as a third step of your closing process. So now to recap, you've got your beginning balance, which is a credit. Increases occur on the credit side, which is net income, decreases on the debit side, which is dividends, and that'll give you the ending balance of retained earnings, which is a normal credit balance. Next, let's take a look at some special situations. First, take a look at this retained earnings account and tell me what you notice is off. Well, you see something called net loss. Now, you know that a net loss is when companies' revenues are less than their total expenses. A company has a net loss. Well, if a company has a net loss, net losses cause retained earnings to decrease. In this example, beginning balance is 0, so it's probably the first year of the company. The company had a net loss, and net losses decrease retained earnings, so that got debited to the retained earnings account, which means that the ending balance of retained earnings is a debit balance. This is not a normal situation. This is when the company had a retained earnings balance that is negative. So it's a negative retained earnings balance, and that retained earnings balance is shown as a debit balance. This is very common for companies that have negative retained earnings. Their balances in their T accounts are debit balances. So here's the explanation. If the company had a net loss in the first year, the ending balance will be a debit balance. Next, here's a situation where the beginning balance is a debit balance. Is that possible? Yes, it is. If you recall, in the previous example, we had an ending balance that was debit. Well, 1st of January of the next year, the beginning balance will be the same balance, but it will be on the debit side. If the company has a cumulative net loss from previous years, the beginning balance of retained earnings will be a debit balance. Next, let's look at this scenario. You've got a beginning balance that's normal, so it's a credit balance. The company made a net loss during the year, so it decreased retained earnings. The company also paid dividends, so that also decreased retained earnings. And then they had an ending credit balance. Is that possible? Yes, it is. If the company had a net loss and dividends during the year, but if that total of net loss and dividends was less than the beginning balance, then the ending balance would still be a positive ending balance, giving a normal credit balance for the ending balance. As a recap, the retained earnings account, the normal balances are credit balances. However, there are situations where you could end up with debit balances for the beginning or the ending balance. If there was a net loss during the year, that net loss would be shown on the debit side and it would decrease retained earnings. Finally, the retained earnings account will always have the beginning balance throughout the whole year. The retained earnings account only gets updated at the end of the year during the closing process. That's it for this video. If you have any questions, please let me know.